The numbers look fine, almost comforting, stocks are rising, unemployment sits near 4%, gas feels cheap again, and yet this calm feels artificial, because this is not strength. This is a sugar high, an economy running on debt, on tax cuts without an end date, on pressure applied to systems meant to resist pressure, fast energy, no nutrition. What you're watching is not growth, it's stimulation, a temporary rush masking long-term toxicity. The story being told is triumph, but the mechanism underneath is fragility. Like sugar in the bloodstream, a spike before the crash, a high that always demands payment. And here's the danger. Sugar highs don't announce when they turn into comas. If you care about what happens next, about 2026, about whether this ends in renewal or rupture, stay with me, because once you understand the system, you will see why the bill is already overdue. Now let's slow down and define the problem clearly. What exactly is the problem here? It is not a recession, not yet. It is not a collapse, not yet. The problem is distortion, an economy judged by surface indicators, markets, headlines, short-term wins, while the structure underneath weakens. Growth is being pulled forward from the future, paid for with debt, with resilience. Tax cuts stimulate demand today, but remove flexibility tomorrow. Tariffs promise strength, but raise costs inside the system. Pressure on institutions creates speed, but destroys balance. This is how fragile systems look healthy, right before they fail, because real economic strength is boring, slow, built on productivity, on trust, on buffers that absorb shocks. What we have instead is acceleration, artificial energy, a system optimized for optics, not endurance. And when endurance is gone, volatility becomes destiny. To understand how we got here, we need to rewind, not to last year, not to the election, but to the moment short-term thinking replaced structural discipline. That is where this story truly begins. To understand this moment, we have to step back, because this did not start in 2025, and it did not start with tariffs. It started when growth stopped coming from productivity and began coming from leverage. Debt replaced discipline. Financial engineering replaced investment. Asset prices replaced wages. As the signal of success, each cycle followed the same logic. Slowdowns were met with stimulus. Stimulus became habit. Habit became dependency. Cheap money masked inefficiency. Deficits filled structural holes. And every problem was solved by pulling demand from the future. At first it worked, until it had to work harder and then faster. And then constantly. This is how economies lose metabolism. Instead of building strength, they borrow energy. Instead of correcting imbalances, they suppress them. Over time, buffers disappear, institutions bend, risk concentrates. What looks like resilience is often just delay. And delays are dangerous, because the longer consequences are postponed, the more violent their return becomes. That is the historical pattern. And now something breaks that pattern open. A single moment, a deliberate shock. Everything accelerates from there. The shock had a name. Liberation Day, April 2nd, 2025. A single announcement, a deliberate rupture, a universal 10% tariff on nearly everything. And on China, rates so extreme, they stopped behaving like policy and started behaving like weapons. The market understood immediately. Within 48 hours, $5 trillion vanished. The S&P 500 fell 10%, the worst two-day collapse since the pandemic. Then came the rebound. Fast, violent, misleading, because the damage wasn't in prices. It was in structure. Tariffs don't punish exporters. They tax your own supply chain. Importers pay first. Consumers pay last. Costs rise invisibly. Margins compress. Inflation seeps in sideways. This was sold as liberation, but it functioned as friction. A supply shock disguised as strength. an inflationary impulse dressed in patriotic language. And here's the trap. Once you pull this lever, you can't unpull it, because now every sector waits, every partner prepares retaliation, every system absorbs stress. This was not a warning shot, it was the first crack, and it forces a deeper question. What kind of strategy invites chaos and hopes fear will do the work? That takes us to the logic behind the shock. What you are seeing here is not improvisation, it is strategy, a modern version of madman theory. The idea is simple. Act irrational enough that others blink first. Threaten extreme tariffs. Signal willingness to absorb pain. Force corporations and governments to move preemptively. At first it worked. Factories were promised. Capital flowed inward. Investments were announced not because the math was good, but because uncertainty was worse. Fear became leverage. But this strategy has a flaw. It only works once, because chaos loses power when it becomes predictable. Each threat followed the same arc: shock, market panic, political pressure, then retreat, pauses, truces, exceptions. The bluff was revealed, and once credibility cracks, leverage collapses. Worse, modern rivals are not passive. They retaliate symmetrically. Tariffs invite tariffs. Pain is answered with pain. Supply chains fracture, exports collapse, volatility becomes permanent. Madman theory depends on the belief that the madman won't blink. But when blinking becomes routine, all that remains is damage. And damage compounds, which brings us to the next escalation. Because trade shocks were only the surface, underneath, the fiscal engine was being pushed even harder. The second crisis didn't arrive with a headline. It arrived with a bill, the One Big Beautiful Bill Act, signed quietly, sold loudly, permanent tax cuts, new exemptions, deficits treated as background noise, consumption held up, another rush, but this time the dosage was extreme. Trillions in future revenue erased, borrowing normalized, debt expanded without a plan for repayment. This wasn't stimulus for investment, it was stimulation for survival. Money flowed upward, balance sheets swelled, but fiscal buffers disappeared. The system became addicted, because once tax cuts are permanent, flexibility is gone. You can't raise rates easily. You can't spend aggressively in a real crisis. You can't respond without panic, and panic is expensive. The contradiction sharpened. Fiscal policy pushed inflation up, while political pressure demanded cheaper money. The system was pulled apart from both ends. Spend more, borrow more, cut rates anyway. This is how credibility erodes. Quietly, then suddenly, because markets don't fear debt, they fear denial. And when confidence breaks, it doesn't fade. It snaps. This was the moment the sugar high crossed into something more dangerous. Not excess, exposure. And that exposure doesn't stay abstract. It moves downstream, straight into the lives of ordinary people. That's where the real cost begins. You feel this part first, even if no one says it out loud. Because when systems break, they don't start on Wall Street. They start in your life. Prices rise before wages do. Rent moves faster than paychecks. Groceries adjust quietly. Every month feels tighter than the last. You're told the economy is strong, but your margin is gone. Work feels insecure. Hours are harder to predict. Finding something better feels risky. So you stay, you absorb, you adapt. That is how pressure hides. Real wages rise on paper, but costs rise faster in reality. You earn more, yet you afford less, and the stress compounds. Because this system rewards scarcity. Less labor means higher wages, but also higher prices. So the raise you fought for comes back as inflation. This is the trap. You're working harder inside an economy that no longer creates safety. And when people lose safety, they stop spending, they stop trusting, they stop believing the story. If this feels familiar, it's because you are not imagining it. This is what fragility feels like before it gets a name. And if you want to understand why this isn't just personal but structural, stay with me, because what happens next doesn't stop at national borders. It spreads. What happens inside one economy never stays contained, because supply chains are global. Capital is mobile. Fear travels instantly. When tariffs rise, costs ripple outward. Factories adjust, shipping routes reroute, allies recalibrate, trade slows, not dramatically at first, then suddenly, partners respond defensively. Retaliation becomes policy, coordination breaks down, and the damage compounds. Higher prices in one country mean weaker demand in another. Currency pressures emerge, investment hesitates, growth forecasts are quietly revised down. This is how localized shocks become global drag, especially when credibility is already thin. Markets begin pricing uncertainty as a permanent condition. Volatility becomes the baseline. Long-term planning collapses. Short-term survival dominates, and geopolitics hardens. Economic tools become weapons. Alliances become transactional. Trust erodes. The world fragments into blocks. Efficiency gives way to redundancy. Redundancy raises costs for everyone. This is the hidden price of constant disruption. Not collapse, not yet, but slow, grinding loss of momentum. And when global growth slows, there is nowhere to hide, which leaves only one question: where does this end? That depends on what comes next. And there are only three paths forward. From here, the future splits, not into dozens of possibilities, but into three. The first is stabilization. Pressure eases, tariffs soften, institutions regain space to operate, growth slows but normalizes, the sugar high fades without collapse, pain is real but contained. This requires restraint, discipline, and time. The second path is stagnation. Nothing breaks, nothing heals. Debt grows faster than output. Inequality hardens. Volatility becomes routine. The system survives, but trust does not. People adapt downward. Politics grows louder. Growth feels hollow. This is the long gray middle. The third path is rupture. Buffers fail. Confidence snaps. Capital freezes. A correction becomes a contraction. Then something deeper. Not because one policy failed, but because too many were postponed. This is how systems collapse. Not from shock alone, but from exhaustion. Which path we take depends on choices made under pressure, because economics is not destiny, it is behavior, repeated at scale. And the most dangerous moment is not panic, it is denial. That brings us to the final question. What do you do when you realize the system is fragile and the clock is no longer on your side? That is where this story truly ends. Here is the hard truth. This system did not break overnight. It was slowly hollowed out by choosing speed over stability, optics over structure, short-term wins over long-term capacity. The sugar high felt good because it postponed pain, but postponement is not prevention. The bill always arrives. It just arrives when defenses are weakest. In 2026, the question will not be, how fast can we grow? It will be, how much shock can we absorb? Because economies don't collapse when numbers turn red. They collapse when trust disappears, when institutions can't act, when households can't adapt, when inequality turns pressure into anger. This is not about panic, it's about awareness. If you understand the mechanism, you stop being surprised by the outcome. And if you stop being surprised, you can prepare. That is why this matters. If this analysis helped you see the system more clearly, stay here. The next video breaks down what this means for you personally and how fragile systems change behavior before they change headlines. Because the most dangerous time is not when the crash happens. It's the moment before, when everything still looks fine.